Investors aren't very confident walking into today's FOMC decision after inflation rose 3 straight months in the US. The S&P 500 posted its worst monthly performance so far this year. The US dollar is up for the fourth month on melting Federal Reserve rate cut expectations. Happily, earnings from Amazon added to the optimism that AI demand remains strong and robust, but even there, the weak forecast for the current quarter got some investors to scratch their heads. So welcome. This is Swissquote's Daily Market Talk. So mood in global risk assets is not very cheery into the Fed's latest monetary policy decision due a bit later today. And it's quite understandable because the Fed must respond to 3 straight month jump in the US inflation and will probably take a step back from its plans to cut its interest rates sometime this year. So there is even a risk that the Federal Reserve drops the "there will be a rate cut this year" stance from its communication, which would be such a big disappointment for the market and the Fed, those that were actually at the start of this year, remember, factoring in up to 6 interest rate cuts from the Fed. So it will be very interesting today to see whether the Federal Reserve will keep that hope of at least 1 interest rate cut this year. That's actually the most dovish statement that could reasonably be expected by the Federal Reserve at this point in time and in the light of the latest economic data from the US. Because the data released yesterday in the US came to back the idea that the Federal Reserve's inflation battle doesn't necessarily continue to move toward the right direction, because in numbers, the employment cost index rose more than expected in the first quarter of this year, and the consumer confidence, on the other hand, sank below the 100 level, but it should yet show in the slowing spending to help inflation tame. This is a thing that we haven't seen just yet. So the S&P 500 fell more than 1.5% yesterday and posted its worst monthly performance so far this year. The US 2-year yield, which best tracks the Fed rate bets, advanced past the 5% psychological mark ahead of the Fed decision today, and the US dollar index extended gains for the fourth month this year. Now, investors will be watching the ADP, JOLTS, and PMI numbers today, but note that they won't change the fact that the first quarter of this year was marked with strong jobs data from the US and a notable rise in the US inflation. So that means that the Fed must address the inflation issue, by keeping its rates higher for longer. And the latter is good for the US dollar and quite mezzo, I would say, for the stock indices. Now, I say mezzo and not necessarily bad for stock indices, because if the first quarter of this year or the first 4 months of this year ended in tears for the Fed, those the AI related stocks lived up to very, very high expectations in the first quarter. All the Magnificent 7 stocks that reported earnings so far, except from Tesla, will surpass the high market expectations. And Amazon, which reported yesterday after the bell, posted the best beats among them, as its AWS cloud platform grew 17% compared to the same time last year, thanks to sustained AI demand, and its advertising services jumped 24% over the same period, thanks to new ads on Prime Video. And all in all, Amazon added just another piece into this AI puzzle, revealing that demand for AI remained robust in the first 3 months of this year, but there is always a but. The stock price rose less than 2% in the after-hours trading, as weak sales forecast for the current quarter tempered optimism regarding Amazon first quarter results. So maybe but just maybe, we will see AI growth level out in the second quarter of this year, and that could eventually trigger a certain profit taking and maybe a pullback in technology stock prices because, well, besides Amazon, AMD also spitted a weak revenue forecast due to soft demand for gaming chips, and stock price fell nearly 7% in the after hours trading. But quickly coming back to Amazon, well, I still believe that Amazon remains a strong AI play for investors because not only they benefit directly from AI investments through their AWS cloud business unit, but AI is also beneficial for the advertisement business, for automated operations, and for logistics. So Amazon is actually in a good place to benefit from both offering and using AI to flourish its businesses, and that makes Amazon an exciting AI stock in my opinion. Price-wise, well, the company is not cheap at all as it has a PE ratio of a bit less than 50 compared to Google's 24 and Microsoft's 33, for example. Yet the company trades just around its long-term ascending line and doesn't seem to be in a price bubble as Nvidia does, for example. Now today is Qualcomm's turn to go to the earnings confessional, and Thursday Apple will be reporting its own first quarter results, and well, we all know that excitement there is much less compared to the other Magnificent Seven stocks after a sharp slowdown in the Chinese business. But as we saw with Tesla this quarter, investors could look beyond the weak quarterly results if Apple just manages to open up perspectives for the futures. And speaking of Tesla, the company lost more than 5% at yesterday's trading session as Elon Musk fired most of his supercharger team, which were doing a business that was, nevertheless going so well across the competitors like Ford and GM that no one among investors or the competitors understood what happened there. So the news came as yet another warning about the unpredictable nature of Elon Musk's decisions at the helm of this company. Now, back to the macroeconomic picture. We had some good news from Europe yesterday. I mean, that was the kind of news that we are not used to anymore. So data released yesterday in the Eurozone show that the Eurozone grew at the fastest pace in 18 months and exited recession in the first quarter of this year. Germany, France, Italy, and Spain, they all exceeded growth forecasts. Core inflation, on the other hand, also slowed in April, though it slowed less than expected. Now, of course, yesterday's better than expected growth numbers combined to hotter than expected inflation figures could have actually weighted on the European Central Bank. But traders were just too busy pricing in the Fed expectations that yesterday's minor surprises from the Eurozone data couldn't really help the euro counter the increased bullish pressure in the dollar. So we saw the euro dollar slip to 106.50 level, and risks are tilted to the downside at today's FOMC announcement. In the energy space, US crude cleared the 50-day moving average and slipped below the $82 per barrel level after the latest API report posted an almost 5 million barrel build in US oil inventories last week. Now, hope of easing geopolitical tensions in the Middle East keep the bears in a dominant position, while the fading expectations of a Federal Reserve rate cut threatens the reflation boost. So that also explains why we saw such a sharp drop in copper futures at yesterday's trading session. But back to oil. The next natural target for the oil bears stands at the $80 per barrel level that shelters the 200-day moving average and the major 38.2% Fibonacci retracement on year-to-date rise. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit that like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.